Welcome to Income Decoded. In 2021, a bombshell investigation changed how millions of people see the financial system. ProPublica, one of the most respected investigative journalism organizations in the world, obtained a massive trove of IRS tax records. What they found was extraordinary. In 2007, Jeff Bezos paid zero federal income tax. In 2018, Elon Musk paid zero federal income tax. Michael Bloomberg, Carl Icahn, George Soros all paid zero federal income tax in certain years. Not through fraud, not through offshore accounts, not through anything illegal. Through a system that most people have never been taught to understand. The 25 richest Americans paid an average true tax rate of just 3.4% between 2014 and 2018. The average working person pays around 14%. This video is not about politics. It is not about whether this is fair or unfair. It is about understanding how the system actually works. Because once you understand it, you can start applying the same principles at whatever level you are at. By the end of this video, you will understand exactly why salary earners pay the most tax, why the wealthy pay far less, and the single most important financial shift you can start making today. Stay with me, this one will change how you see money forever. Let us start with how most people earn money. You go to work, your employer pays you a salary. Before that money even reaches your bank account, the government takes its share. Income tax immediately, automatically on every dollar you earn. In most countries, income tax rates are the highest rates in the entire tax code. Depending on where you live and how much you earn, you could be paying 20, 30, even 40% or more of every dollar you work for. And then you spend what is left. This is the earn-spend tax cycle that most people live inside their entire working lives. Earn, get taxed, spend what remains, earn again, get taxed again. And here is the part that most people never question. This cycle is completely normal, it is expected, it is how the system is designed for people who earn salary. But it is not the only way the system works. Now let me show you how wealthy people earn money. Wealthy people do not primarily earn salary. They own assets. Businesses, real estate, stocks, private equity. Assets grow in value over time. That growth is called unrealized gains. And here is the critical insight that changes everything. Unrealized gains are not taxable income. Until you sell the asset, you pay no tax on its growth. None. Bezos' wealth grew by approximately $80 billion in 2024. Musk's wealth grew by approximately $213 billion in 2024. That growth was not taxed, not because they cheated, because unrealized gains are not considered taxable income under the law. The asset grows, the wealth grows, no tax event until the moment of sale. Now you might be thinking, but eventually they have to sell, and when they sell they pay capital gains tax. That is true, but here is where the strategy gets genuinely extraordinary. The wealthiest people in the world have figured out how to access the value of their growing assets without ever selling them. This strategy has a name. Buy, borrow, die. Let me walk you through each step. Step 1. Buy. Buy appreciating assets, stocks, real estate, stakes in companies, assets that grow in value over time. Hold them, do not sell, let them compound. The assets grow, no tax, no event, just compounding wealth. Step 2. Borrow. Here is where the genius of the strategy reveals itself. Instead of selling assets and triggering a taxable event, the wealthy borrow against their assets. Banks will lend 70 to 90% of the value of a portfolio as collateral. Elon Musk and Larry Ellison borrow enormous sums of money pledging their stock as collateral. Bezos earns $81,000 a year in salary, low enough to qualify for the child tax credit, which he took in 2021. Because his wealth does not come from salary, it comes from borrowing against assets that are growing faster than the interest he pays on the loans. And here is the most important point. Borrowed money is not income. You do not pay tax on a loan. A billionaire can borrow $100 million, live on that cash, fund their lifestyle, and pay zero income tax on it. Because it is not income, it is debt. And the assets continue to grow, untaxed, as collateral in the background. Step 3. Die. This is where the strategy becomes permanent. When wealthy people pass their assets to heirs, those assets receive what is called a stepped-up basis. This means the IRS essentially resets the cost basis of the assets to the current market value at the time of inheritance. All of the unrealized gains that accumulated over decades are permanently erased from a tax perspective. The heirs inherit the assets, the heirs sell the assets, they pay capital gains only on growth since they inherited, not on the decades of growth before. The step-up basis rule alone costs governments an estimated $41.9 billion in foregone taxes every year. Buy, borrow, die, 3 steps legally used by the wealthiest people in the world. Now let me explain the second layer of this system that most people never understand. Even when the wealthy do pay tax on investment returns, they pay at a lower rate than salary earners. In most countries' capital gains tax, the tax on profit from selling investments is lower than income tax. In the United States, long-term capital gains are taxed at 0, 15, or 20% depending on income. Compare that to income tax rates, which can reach 37% federally. An investor who holds a stock for over a year and then sells it pays capital gains tax. A worker who earns salary pays income tax. Same dollar amount, different tax rate, investor pays less. The argument for this structure is that investment drives economic growth, that lower capital gains taxes encourage people to put money to work in the economy. Whether you agree with that argument or not, the structure is the reality. And it means that the source of your income is just as important as the amount of your income. Salary income, highest taxed. Capital gains, lower taxed. Borrowed against appreciating assets, not taxed at all until repaid. Now here is the part that actually matters for you. You do not need to be a billionaire to start applying these principles. The strategy scales down to every level. Principle 1. Own assets instead of just earning salary. Every dollar you invest in index funds, real estate, or a business is a dollar working in the lower taxed or untaxed portion of the system. Salary income gets taxed immediately at the highest rates. Investment returns compound untaxed until realized. The most important financial shift you can make is to start directing money toward ownership. Principle 2. Hold investments long-term. In most countries, holding an investment for over a year qualifies you for lower capital gains tax rates. Short-term traders pay income tax rates on their profits. Long-term investors pay capital gains rates. The tax code literally rewards patience. Principle 3. Use tax-advantaged accounts. Most countries offer some form of tax-advantaged investment account. Contributions may be tax-deductible. Growth may be tax-free. Withdrawals may be tax-free depending on the structure. These accounts are the closest thing ordinary investors have to the billionaire strategy. Money grows without triggering annual tax events. Use them, maximize them, understand how they work in your country. Principle 4. Understand the difference between realized and unrealized gains. If you own index funds that have doubled in value and you have not sold, you have unrealized gains, no tax due yet. The moment you sell, you realize the gain, tax is triggered. This is why long-term passive investors pay far less tax over a lifetime than active traders who buy and sell constantly. Every sale is a taxable event. Every hold is tax-free compounding. Let me be completely clear about something. The strategies used by the ultra-wealthy involve resources and legal structures that are genuinely out of reach for most people. The ability to borrow hundreds of millions at low rates against a stock portfolio requires being already enormously wealthy. But the underlying principles are the same. Own assets, let them grow, minimize taxable events, be patient. These principles are available to anyone who starts investing, at any income level, in any country. The system was not designed with ordinary investors in mind. But ordinary investors can understand the system. And once you understand it, You can position yourself within it more intelligently than the vast majority of people who never learn any of this. Quick recap of everything we covered today. In 2021, ProPublica revealed that the 25 richest Americans paid an average true tax rate of just 3.4%. The average worker pays around 14%, all completely legal. The salary earn tax spend cycle keeps most people paying the highest tax rates in the code. Wealthy people primarily own assets, businesses, stocks, real estate. Asset appreciation is not taxable until realized. This means wealth can grow for decades with no tax event. The buy, borrow, die strategy: by appreciating assets, borrow against them instead of selling. Borrowed money is not income. Die and pass assets to heirs with a stepped-up basis that erases unrealized gains permanently. Capital gains tax is lower than income tax in most countries. Long-term investors pay less than salary earners on the same dollar amount of gain. What you can do: own assets instead of just earning salary. Hold investments long-term. Use tax-advantaged accounts. Understand the difference between realized and unrealized gains. The system is not going to change for you, but you can change how you operate within it. Drop a comment below. Did this change how you see the tax system? Did you already know this, or is this the first time you are hearing it clearly explained? I read every single comment and I reply to as many as I can. If this video opened your eyes to something nobody else explained clearly, please hit the like button right now, 2 seconds, and it genuinely helps this channel reach more people who need to understand this. Now before you go, here is what is coming next. You now understand why wealthy people pay almost no tax. But here is the next question. How do you actually start building assets at any income level? What is the most important number that determines whether someone builds wealth or stays broke, regardless of how much they earn? Next week on Income Decoded, we cover the one number that predicts your financial future more accurately than your salary, your job title, or where you live. Hit that red subscribe button right now and turn on the bell. Because next week we find out if you are actually building wealth or just earning money. I will see you then. Stay focused, stay consistent, and remember, it is not about how much you earn. It is about how the system treats what you earn. And now you know how the system works.